Welcome to the You Don't Know What You Don't Know podcast by Innovative Business Advisors. Successful business owners who have started, grown, and led businesses share their journey and direction for the benefit of those traveling the same path.
Today, we're honored to have with us Terry Lammers, who's my partner and a founding member of IBA. And Terry, in his business career, has done more than 30 acquisitions. He sold his company for greater than 8 figures. He is a highly sought-after business coach and author, and is a finance major, entrepreneur, and certified valuation analyst. Terry knows how to build value in companies and has a heart for teaching that skill to business owners. So, Terry, welcome. How you doing?
Thanks for having me. That sounds overly important.
Well, you are overly important. You've accomplished a tremendous amount, and it's an honor to work with you. So, Terry, I wanted to talk a little bit today about the business environment that we work in, right? And you and I have talked about this a lot. And I thought it might be helpful to our audience if we talked about, after all the success that you've had in building and selling a $40 million plus business, right? You went back to school and you became a certified valuation analyst. What did you learn in earning your CVA?
You know, that's a really interesting question because I've bought a lot of businesses and, you know, I have my way of valuing them. And I think we've said it before, valuing a business is as much as an art as it is a science. So there is a lot of objective perspectives that you put into valuing a business. But I think the main thing is, especially you and I value a lot of smaller businesses, and we come back to the bankability of it. Is it a bankable deal? So if I say your company's worth $3 million, can you put a reasonable down payment and have a debt service coverage ratio, which is, you know, the amount of money coming in to cover the debt payments, and have that be acceptable? I think the second piece in evaluation, which is hard for us as valuators, is, you know, we do a financial valuation. So we're valuing the cash flow of the business. But, you know, there was a lot of companies that I bought that were very strategic in the fact that I could eliminate a ton of their operating expenses. So the cash flow with me running the company is going to be significantly more than the current owner. Or are you buying the company and it's going to add products or services to your current customer base that you don't have right now, which will enhance, you know, the two together create a synergy. So I think you have the quantifying what the cash value of the cash flow is, and the bigger the company, the higher the multiples, but also to really look at, is this a strategic valuation or strictly a financial valuation?
Yeah, and those are significantly different, right? So financial valuation tends to be kind of math-driven.
Well, so what's interesting is in the front of every one of our valuations is revenue ruling. Is it 49? I'm missing it. But it's a revenue ruling that basically says your company is worth what somebody else is willing to pay for it.
Uncoerced,
and knowing all the truthful facts that are out there.
Yeah.
And it actually took me a couple years as a valuator to think about that. And it's like, you know, it is really true. Your company is worth what somebody else is willing to pay for it, knowing all the relevant facts.
Mm-hmm.
Boom. That's it. Doesn't matter what I say it's worth. Doesn't matter what you say it's worth. Doesn't matter what you think it's worth. That's the value of the company.
It's also kind of interesting for small companies particularly, and I'm talking about companies that have an enterprise value of less than $5 million, right? So it might be $250,000, it might be up to $5 million. You and I have seen a lot of valuations whereby they'll use tools within the valuation in a discounted cash flow methodology most often that said, okay, this company is going to grow by X percent a year. And now all of a sudden, if you apply this level of growth rate to their revenue and cash flow, now all of a sudden this company is worth significantly more than it might be worth if you had to go borrow the money to buy it.
Yeah, and that immediately brings to mind a valuation that I did on a company. There was 4 owners. So classic situation, one died, and the other 3 wanted to buy the other 2 sons out that inherited that 4th. Mm-hmm. And I had the privilege of looking at a previous valuation from like 5 years ago, and they did a discounted future cash flow, and that's where they put a growth rate on it, and the company, it consistently kicked out like $400,000 a year. Well, they did this discounted future cash flow and valued the company based off of $700,000 in cash flow. Well, fast forward 5 years, and I'm asked to value the company. Guess how much the cash flow of the company was? $400,000. So I'm not a firm believer in that, and obviously there's going to be situations where you'll get that value, but I don't like valuing companies that way.
Yeah, and you certainly will see valuation experts that use that methodology, and it is one of the recommended methodologies. But that's why we're so prone to the bankability side for smaller deals anyway.
I mean, you remember the one that we did? You and I both valued the company at $8 million. The owner, and we had a willing and able buyer at $8 million. The owner went and sought another valuation from a CVA, and he came back with a $15 million valuation. Well, it wasn't bankable. The potential buyer wasn't willing to pay that. And 5 years later, the company hadn't sold because the owner dug his heels on the $15 million, and it wasn't feasible. That's what's really sad about a valuator overvaluing a company, because it can make it unsellable, and then in the current owner's mind, they get dug in that it's worth so much more. And I remember one time, and I'm sure you and I talked about this in the past, but I called the valuator out on it. I called him because I was upset. I'm like, what in the world? How did he come up with this number? And I called him, and he goes, well, I valued it that high because I knew he wanted to sell the business, so I wanted to give him a good number. I'm like, well, congratulations. You just ruined the sellability of this company, and the guy's not going to get it, So
you just made it unsellable.
Yeah, it's sad. It's sad.
Yeah, and you and I both know that banks do the math. They do the math before they do the loan to say, is there enough cash flow to make the payments?
Yeah, hence why we really like the bankability method, because it's got a cash flow.
Yeah, we like it so much we trademark it.
Well, and the other thing of it is, like I said, a lot of the companies that we're valuing are primarily under $10 million in enterprise value. So most of those buyers, they're not private equity groups, they're individuals or another small business. So they have to borrow the money to buy the company. When I sold my company, they're looking at just more of a return on equity because they had the cash, so that all makes a difference. But that's why you're going to get higher multiples with larger companies.
Let me change the subject on you just a little bit. Most business owners, as we talk about all the time, very seldom do they think about what is the value of their company. Most business owners think in terms of sales and raising sales and growing revenue. And they have this mindset that the more I raise the sales volume, the more I raise the revenues, the more valuable my company is going to become. What's your perspective on that?
So you're really trying to push my buttons, aren't you? So I have two mantras, as you very well know. One is, it is not about sales. I could care less what your sales are. It's all about gross profit and the cash flow of the company, not sales. So most people think sales, net income. It's about gross profit and cash flow. If you can't convert the sales into gross profit, it's not doing you any good. And from the gross profit, what are your operating expenses? And depreciation is that number. So you always got to remember depreciation is a non-cash expense. So you have to add that back. So what is the true cash flow of the company? And that is ultimately what the value of the company is based off of, is the cash flow of the company. But we get people come to us all the time. It's like, my sales are up $500,000 this year. And it's like, so? And they look at you kind of funny, and you're like, did your gross profit go up exponentially? And that's why, it's kind of a little bit of a side note, but that's why we like to look at percentages and not numbers, because you can be growing your sales, you can be growing your gross profit, but is your gross profit growing at the same percentage of sales as it did before? If it's dropping, that means you're just selling more stuff, but you're not yielding the cash from it. And then likewise, what's your percentage of cash flow? If that's dropping, then you're getting heavy on operating expenses, or, something else is happening. So very important to look at percentages versus just strictly the numbers, especially in a growing company.
Yeah, because it is very easy. An easy way to grow is just reduce your price, right? You reduce your price and you eliminate your gross margin, you can grow your top line pretty quickly, but there's nothing left over at the end of the day. So what's the point?
Correct. Yeah.
It is an amazing difference in that regard. And why do you think that's so hard for business owners to grasp?
I think most business owners are wrapped up in the day-to-day operations of the company, and it's always just blown my mind. I mean, I think the highest valuation I did was a company for $50 million, and the owner of that company had absolutely no idea what cash flow meant. He had absolutely no idea what EBITDA was, but he could sure as heck tell you how to run his business. So it is kind of funny. They don't, it's really checkbook management. Is there cash in the checkbook? Good. If there's a lot of cash, we'll go buy something else. But, are they taking time to get into the weeds?
Yeah, that's so true. It seems like accountants almost always focus on reducing taxes for business owner customers. What's your perspective on that?
It's sad. That's kind of another thing that the owners are always proud of is like, I didn't pay any taxes. Well, if they beat the income of the company down, unless it is explainable how they did that, as far as add backs, as far as the valuation, you're not adding value to your company. So, it's a strong argument that in the last 3 years before you sell your company, you need to drive every dollar to the bottom line and increase that cash flow. And unfortunately, that may mean that you're going to pay taxes. But at the end of the day, it's going to increase the value of your company exponentially.
Yeah. And when you are selling your company, this is, I think, the hardest thing for sellers to get their arms around, at least in my experience. And I want your opinion on this as well. When you're selling your company, basically, you are getting paid for the past performance of your business. You're not getting paid for the future potential of the business. Now, if you've got a strategic purchaser, as you alluded to earlier, they may have some strategic value that they apply on top of their purchase price. But for the vast majority of the time, particularly for small transactions where they have to go get financed, the bank's making a decision based on the history of the business, right?
Yes. And so that kind of alludes a little bit to my second mantra, which is it's not about how much you sell your company for, it's how much you get to keep net of taxes from selling it.
Yeah.
So there's kind of two parts to that. One, yes, you want to pay attention to your taxes, but don't let it shoot the value of your company. And two, when you go to sell your business, do some tax planning because, as you very well know, I mean, we've had situations where if they sell it one way, I had a trucking company, they was actually going to have to bring a check to the table to sell the company because it was still a C Corp. But we ended up selling it a different way, and they still walked away with a pretty nice check.
Yeah, it's a big difference.
It is. And, another thing that we always talk about is it's all about your team. Who's your team of people? Who's your financial advisor? Who's your CPA? Who's your attorney? Attorneys are, especially in selling the business, attorneys are a big deal. I mean, they can make or break deals all day long.
And I think you're alluding to, that's one of the big difference between, are you simply using a broker to help you sell, or are you using a broker as part of a team effort to make sure that you really get the maximum value out of the deal?
Which alludes to your book. But yes, that's correct. I mean, we purchased a company recently. We got the deal done in 8 weeks. We met with the guy on July 5th, and we closed on September 1st. And when we met with him on July 1st, we made an offer on the price. He accepted it. He liked it. It was fair. And then he told us we need to close by September 1st. And there was real estate involved. And it's like, oh, boy. So I told the guy, I said, look, we can do this, but there can't be no BS because we got to plow through this. You need a good attorney. And to his credit, he got a good attorney, and we hammered it out in 8 weeks. On the flip side, I got a company we've been trying to buy for 2 years, and the owner's unrealistic, and attorney's difficult to deal with, and it's an impossible situation.
It is so amazing how the team can make all the difference in the world, not only in the speed of the transaction, but in the result of the transaction as well.
And right back to your accountant, it's like, well, and I wouldn't blame the accountants. A lot of small business owners they're like happy. It's like, I filed an extension. I don't have my taxes done. Well, congratulations. But if you're going to sell your business, we have to have up-to-date financial statements. So all these things come into focus, especially when you're getting ready to sell the company, because you got to have solid financial statements. You got to have your tax returns up to date. cash flow is all about the name of the game, so don't try and beat it down just to save yourself a nickel on taxes. It's an art.
Yeah, and it's particularly, what I'm hearing you say is it's particularly important as you get closer to, your particular exit. So if you're a business owner that's looking forward to the fact of, at sometime in the next 1, 2, 3, 4, 5 years, I want to exit my business. Now it's the time to kind of pivot the way you do things and really go to town on putting as much profit on the bottom line as you can, because you'll get paid for it that way.
Yeah, and the other thing that I would encourage people to do is, even if you think you're 10 years out, have your company valued, because it's really sad. And I tell a story in my book. I had somebody come in and the guy calls me and he's like, I don't need a business broker, but I just wanted to pick your mind a little bit about the value of my company. So he comes in, gives me his tax returns, and I look at them, and they're expecting an answer to snap of a finger, but they had about $1.2 million in sales and for the cash flow that was coming out of the company. And I asked, is there any add backs, meaning personal expenses, things like that. And they're like, nope, mom does the books, everything's squeaky clean. I'm like, all right. It's like, I don't know, I would say it's worth around $250,000. And the wife looks out the window of the office and the husband looks at the ceiling. And the next thing I look back at the wife and there's a tear rolling down her eye. And I'm like, okay, time out. What, obviously that's not the number that you was expecting. And he said, well, we have over $1 million a year in sales. So I thought the company was easily worth $1 million, and they wanted to retire in 6 months. And in 30 minutes, I blew a hole in their financial plan to retire in 6 months because they needed the money to retire. So I think it is very prudent for a business owner to think about having your company valued and talking to the valuator, as we do when we value a company. And, this is a realistic value of the company. These are the things you need to think about to drive value to grow the company.
Yeah, it is amazing. And, not only in our experience, but industry-wide, fewer than 1 out of 10 business owners ever do that valuation up front ahead of when they really decide to make a change and exit their company or retire. And so thus we see all the time, they come in and the number's not what they expected it to be.
I mean, it is kind of crazy. I mean, it's like I was guilty of it too as I was growing my company. I never really thought about it too much. It wasn't until after I sold the company that I really got into this business of valuing companies. But I mean, I bought a lot of companies, so I knew how to value. I knew what I was paying for, but I never probably gave as much thought to my company as I probably should have.
Well, as a buyer, were you always thinking as a strategic buyer, well, if he's generating $100 a year in cash flow, I could probably do $200 a year in cash flow by taking out so-and-so expenses?
Yeah, you're making me laugh because I think I talk about it in the book also that me and my accountant always butted heads because he was like, you pay for a company for the value of its cash flow. And I'd be like, but Mike, if I buy the company, I can do this, this, and this, and it's going to make that. And he's like, that's not what you pay for. So yes, I was always thinking from a strategic standpoint. And, we talked about the bankability of the company. So, which goes back to you're paying for the current cash flow of the company. But there is other companies that'll pay you for the strategic value of the company. And I very fortunately benefited from that because the company that bought my company, they have a whole acquisition department. I asked her, because you get to know them after a while, I said, what's your trigger point? What makes you pull the trigger on buying a company? She answered one word, 33%. They are looking for a return on investment of 33%. But it's not 33% of what the current cash flow of my company was. It's 33% of how they perceive the cash flow of the company after they buy it. So we talked a lot about bankability and the current cash flow of the company and stuff like that. But especially when you get to larger companies, they will look at it as a return on their investment and what they perceive that future cash flow. So future cash flow gives you an inkling as to what most buyers are looking for. They may only want to pay you for the current cash flow, but in your story of selling the company, it is about what is the potential future cash flow of the company.
Yeah, you kind of sell the potential, but you get paid on the performance.
That's a perfect way of saying it.
Yeah. What do you think for business owners? What do you think is the most important thing that they can do to maximize the value of their business?
I think a lot of it's keeping clean financials, and the numbers don't lie, but you got to have clear financial statements. It blows my mind all the time, even if we're just doing a valuation and they're not ready to sell the company yet. Send me 3 years of tax returns and financial statements. Well, I got an extension, or, I only do my financial statements once a year. You got to have solid financial statements and really concentrate on the cash flow of the company. I mean, that's it. The cash flow of the company is going to determine the value of the company. Oh, and then, the other thing is to talk about non-financial things that affect the value of the company. Remember, we had a company for sale. The guy was cash flowing over $1 million a year. Phenomenal. But the owner was overly involved in the business. I mean, the business was located out in the middle of nowhere. So, nobody wanted to move to the small town where the company was located. But then the first question that came up, it's like, what happens when the owner leaves? Because he was intimately involved in the business. Somebody had to fill that hole. So you're not buying a business, you're buying a job. And that's a problem. I mean, that's the non-financial things are really almost become more than the financial things. I mean, the cash flow is one thing, but is the owner overly involved in the business? Where is it located? Things like that can really have an effect on the business.
Yeah, the cash flow looks great, but if a buyer doesn't believe that they can duplicate that cash flow, it's not worthwhile.
And a lot of our buyers, they are purchasing as an add-on. So again, it gets back to, are you buying a business or are you buying a job?
Yeah. And for smaller companies, most of the time, they're buying a job.
They are, and that's why it really becomes important with the bankability method, and that's what's going to drive the value of the company.
Yeah. For companies that are out there operating today and they're thinking about, there's some potential out there that the business has. The owner's always thinking about this business has more capability in it than I'm able to realize, right? What do you think holds businesses back or business owners back from reaching the potential that they think is evidence in their business?
I think a lot of it is the non-financial things that can really affect the value of the business. As an owner, you got to get that business to where you as the owner aren't involved in it, and that somebody can come in and take a look at it and say, I'm going to step in and manage this thing, but there is a staff of people that can run it. And that's hard to do. It's hard as a business owner, and if you grew this baby, to step away from it. So my case personally, I remember seeing another business owner do it, and I'm like, that's pretty slick. Because everybody wants to call you. I mean, every time the phone rang, they want to talk to Terry. So Tony was my right-hand man, and when they would call, I would have Tony call them back. Well, the second time they called asking for me, and Tony would call them back. Well, guess what? About the third time, they're calling Tony. Mm-hmm. And it's interesting that towards the end, probably the last 4 or 5 companies I bought, I really didn't know a lot of the customers because I had a company full of people that ran it, and they did their job and pay them well. And, my job was to go out and look for more companies to buy.
Yeah, that's the owner's prerogative.
And that's part, of our upcoming book. It's going to be You Don't Know What You Don't Know, the entrepreneurial trap. And that's one of the traps. The owner gets caught in, I'm the one that's going to unlock the door. I'm the one that's going to tell every driver or whatever where to go. It's like, no, you need to get out of that. You need to be the driver of the company. But it takes time. You got to have the money to do it. But when you make the switch, wow, that's when you start seeing some real growth in the company, and that's when you can really start to add value to the company, because the day-to-day things happen on their own. You manage that, and then you focus on growing the company.
Yeah, and growing the company by making strategic moves, not daily tactical moves, right?
I mean, obviously you can, there's 2 ways to grow a company, organically and through acquisitions. And organic growth, that can happen. And if you have the type of business, I don't know, what's coming to my mind is an insurance company. It's really easy to open another office in different towns versus I was in the fuel and lubricants. It's like, well, to build a bulk plant in another town's a $400,000 proposition. And you got to get the customers to make that a viable asset, going through. So how easy is your company to grow geographically, and how do you acquire those customers? Specifically, the company that bought mine, I didn't know it at the time when I sold the company, but they had just bought a lubricants blending facility in Council Bluffs, Iowa, and I had a packaging facility in Southern Illinois. So I was a very strategic acquisition for them, one, because I was their largest competitor in Southern Illinois, but two, when they bought me, they had a packaging facility, and they got 500,000 gallons in lube sales right out of the gate. Now they wasn't trying to build a lube business. They was in the lube business. So, that's kind of back to a strategic acquisition.
Makes it easier, right? They're basically acquiring capabilities and customers at the same time.
And nowadays, employees.
Yeah, that's a big thing that we're seeing now, right? If it's hard to go find employees, sometimes it's easier to buy the company where there may already be a good group of employees.
Even the company where I had my packaging facility, when I bought it, I needed a larger lubricants facility because we did bulk oil, but we was busting at the seams. And for what I paid for that company, I couldn't build the facilities that he had. So I got the facilities that I needed, but it's like, oh yeah, and you got all these customers to go along with it. So there's just a lot of ways. Obviously I'm in the business, but I love acquisitions. It's a great way to grow. It's a great way to grow geographically. It's a great way to expand your current product base. I talk about it in my book also. I have a friend who owns a hardware store type of business, and I think they owned 4 of them, and they bought a 5th one just because that was going to get them to the size where they could buy containers of stuff versus the way they was buying it. So now they can buy containers overseas. It's going to reduce their cost of goods sold. It's going to reduce their purchase price of products that they're going to sell.
Well, you're kind of the prototype of that whole strategy, too. I mean, you took a less than $400,000 a year company and turned it into a more than $40 million a year company, primarily through acquisition.
Yeah. I bought 2 companies in one town, 3 companies in another town, and you just start putting them together, and the efficiencies pay for themselves.
Well, it's hard to build a retirement income on a $400,000 a year company, but when you sell a $40 million a year company, it's a little bit easier to build a nest egg and a retirement income.
And that's where your financial advisor comes in, because we see that quite often.
Yeah.
And it gets back to the second mantra. It's not about what you sell the company for. It's about what you get to keep net of taxes, because a lot of the times, say somebody wants to sell their company for $5 million, but in today's world, you may end up paying 50% of that in taxes. I can lay out a scenario for you where you could sell your company for less money and still end up net of taxes more than selling it for a higher value and taking a hit on the taxes. But that's where it's back to building your team. It's where your financial advisor really comes in, and you need to make sure that when you sell that company, you have enough to get you personally to your end goal that you're taking care of, because, it's kind of like you're killing the goose that's laying the golden egg.
But it all kind of starts with knowing where you are, right? It's hard. We both know it's hard to hit a target that you can't see. So unless you start with that valuation and know where your current position is, it's kind of hard to know if you can meet the destination that you're headed towards.
You don't know what you don't know, right?
You don't know what you don't know.
Yes, you're exactly right. Hence, I said earlier, don't wait until the year you want to sell your company to get a business valuation. That needs to be an ongoing conversation, specifically between your CPA and your financial advisor. And I think it's important to note, too, that pay attention to who your financial advisor is. A lot of people, when they don't have a lot of investable cash, start with a financial advisor, and it's probably not as bad as it used to be years ago, because they're all fiduciaries. What's a fiduciary mean? It means they can be held liable on how they invest your money, because when you don't have a lot of investable income, you typically end up at a financial advisor that is selling products that they earn a commission off of. So when you get especially over $1 million of investable assets, they're typically more of a fiduciary, which means they are earning a percentage of your invested assets. So they are encouraged, obviously, to grow the value of your asset base, because that's how they're getting paid. They're not getting paid by selling you products. And that is really important. It's like hit the rewind button, listen to that again, because I've seen it from my short stint in the banking industry where you will have people giving you financial advice that are going to push products on you because that's how they earn their commission. That's a big way they get paid.
Yeah, it's kind of like having your advisor move from across the table to sitting next to you on the same side of the table, because now they're incentivized as a fiduciary. As they grow your wealth, that's how they get paid off of that growth.
Yeah. And people have a hard time understanding that, because all those fees are hidden.
Yeah.
You really don't see them when you're buying it. And it's confusing.
Yeah. Well, we've talked about a lot of things today, and I think it's very insightful. I always learn something every time I sit down with you. What's the one key piece of advice that you'd like a business owner to take away from this session together? What would you offer as that one key thing to not forget?
I think I have to go back to my first mantra. It's not about sales and net income. It's about gross profit and cash flow. I don't care what your sales are. You could have a company with $100 million a year in sales, but if you ain't generating any gross profit from it, big deal. Or if it's not creating cash flow, it doesn't matter. I laugh. I mean, we see companies that the guy owns a computer and he's making $500,000 a year, and his total investment is a $2,000 computer, and it's like, geez. And you see other companies that have, these huge working capital requirements. They're not generating any cash flow. So the other thing that we didn't talk on real quick, and I know we're wrapping up, but I think it's worthwhile touching on real quick, is the working capital of a company. You have to think that when you're selling your company, you're writing two checks. You're writing one check for the value of the company, but you need another check or sum of money to cover the accounts receivable and inventory. And that can really kill the value of your company. And my company was a perfect example. I had a $4 million accounts receivable and about $2 million in inventory. So whoever bought my company, they're writing a check for the company, but they still need to bring about $6 million to the table to cover the accounts receivable and inventory they're going to inherit. And that can create obstacles, especially with your banking, if you need an operating line to cover that. So two things, I guess, to answer your question. For one thing, gross profit, cash flow, and keep in mind that the working capital requirements of the company can also affect the value of the company.
Yeah, I think the bottom line is numbers are the language of business, right? And if you don't know your numbers that well and you don't understand these things, give us a call. We'll help you sort it out and teach you how to.
So, yes, the third thing is then get yourself educated. I mean, it really is important. I mean, it's just really sad to people that come to us and, they always want to sell their company in next week, which it doesn't happen that way most often. And they completely don't understand their numbers or the process, and it just doesn't help the outcome.
Yeah. Well, Terry, thanks so much for your time today. I think it's always an honor and a pleasure to sit down and talk these things with you. And I think people that listen to this will get a heck of a lot out of it. How can they reach you if they've got additional questions and they'd like to talk to you further? What's the best way to get in touch with you?
I'm never shy about giving out my cell phone number at 618-530-8922. Our website, www.innovativebaboyapple.com, is a great place to go. All of our contact information is on there. If you click under the media tab, you'll see a ton of articles that Steve and I have wrote and videos on some of our presentations. So there's a lot of information there. The website for the book is www.youdon'tknowwhatyoudon'tknow.com. There's 4 books that have been published. Mine, Steve's co-authored another book. Then the 4th one, I believe, was on franchises. And Steve and I are writing the 5th book right now, which will be You Don't Know What You Don't Know, The Entrepreneurial Trap. And that really talks a lot about situations we see owners get into that upends them from getting their company sold. So I think it's going to be a good book. We have the chapters laid out. Now we just need to lock ourselves in a room and write it.
Yeah, get it knocked out. We know the stories behind each of them, so it's a fascinating deal. Well, Terry, thanks again.
Thank you, sir.
It's always my pleasure to work with you, and thanks for your time today.
Thank you for listening to the You Don't Know What You Don't Know podcast. We invite you to visit www.youdon'tknowwhatyoudon'tknow.com and sign up to receive updates on upcoming episodes. You can also let us know if you'd like to be a guest or recommend a business owner to be interviewed. Find us on LinkedIn, Facebook, and YouTube. where you can like, follow, share, and join our efforts. Thanks for listening. We hope you join us again.